I'm Charlotte McLeod with the Investing News Network, and here today with me is Gareth Soloway, Chief Market Strategist at inthemoneystocks.com. Thank you so much for joining me online. Great to see you as usual.
Yeah, great to see you too. Glad to be back.
Yeah, so we are catching up after the summer, and I know that this is typically a slow time. Definitely in the resource sector, we're feeling that doldrums type of time. Hopefully it's coming to an end. But I know that you're always looking for opportunities and you seem to be able to find them basically wherever you can. So over the summer, where were you seeing opportunity? Where were you trading?
Wow. So, I mean, with the volatility in the stock market, there's been some great plays. You know, the markets had gotten crushed from June into through July into early August. Then we saw the stock market stage a massive rally up, then a big fall just in the last couple of weeks before this latest bounce. So I would say in stocks, it's been tremendously good in terms of swing trading and day trading and kind of positioning yourself. And then I also think, you know, gold is starting to look very interesting down here. It's looking like it's trying to hold support. And I think the biggest thing out there that investors should be paying attention to is the dollar and then the 10-year yield. And those both have been on a tear lately, although it does look like the dollar may have topped.
Okay, so lots of things to get into. Let's pick up on what you're saying there about the dollar and the 10-year yield. Definitely been hearing about strength in the dollar. Is that set to continue in your mind? What are you seeing there?
So short term, we probably have a near term top in the dollar. It doesn't necessarily mean we can't go higher in a few months, but there were some key things that actually happened here. And I'm going to bring up and I'm going to show this chart for you guys. Let me just bring up my charts here and I'll show you guys what we have going on. But if we look at the US dollar, the USD JPY, which is the dollar yen, I want to show you this. So this is a line that I was following recently, and you saw the yen was just getting crushed against the dollar more and more. But look at the trend line that we just hit a couple days ago. And that to me was a signal that the dollar may start to weaken. And sure enough, we've started to see that. We should see a continued pullback on the dollar yen all the way back to at least 139. So there should be some more downside. That does imply that the dollar, the DXY, should also stay weaker in the near term. But that was a big one for me. Like so much of this market has been driven by the strength in the dollar. And what I mean by that is as the dollar was going higher, stocks and risk assets were getting crushed. We even saw gold getting crushed, right? So the fact that the dollar near term has topped, it should give the stock market, crypto, a little bit of a reprieve to maybe have a small bounce higher.
Okay, so that'll definitely be something to look forward to. And I want to talk about a few things that we have coming up. We're talking right now on September 9th. It's a Friday. In the next couple of weeks, there are a bunch of things that are happening. I believe coming up next week, we will get the latest CPI data, which will cover August. I wanted to ask you about that. What do you see coming? But in addition to what you see coming, what are the points that you look for when that type of report comes out?
So definitely we're looking at that headline and core number on the CPI data. So the consumer price index, which basically is what the market's paying attention to so closely because it's what the Federal Reserve will likely gauge their next rate decision on, right? So if you still see very high inflation and it's not coming down, it's likely going to signal the Fed has to do 75 basis points at the next meeting. My guess is, considering, I mean, you look at oil and oil has collapsed into the mid 80 range or so. I mean, we've seen copper, we've seen nickel, all of these commodities have come down so sharply. It should be trickling through to the consumer price index, which means inflation should show that it is kind of fading a little bit. Now, I think the kicker is going to be this, is that I don't think we're going back to that 2% or under that the Fed really wants us to get to for years. And I think that's going to be a big issue down the line, as they're not going to be able to stimulate if we go into a recession. So if you think about it, every recession we've had for the last 20 years, basically, the Fed has stimulated in some way, whether it's printing of money or dropping interest rates or buying bonds to have on their balance sheet. They've been doing massive stimulus. That was all with 2% or less inflation. The fact is, we're at a point where unless they get that below 2%, they can't print money again to save us from the next recession. And that's the boogeyman to me. That's the real scary thing. If this economy goes into recession, how do we get out without the Fed's help?
Right. And when we talk about inflation, I believe you said before you see it getting sticky at that 4 to 5% level. Is that still what you're thinking there?
Yeah, I'm kind of right in that 4%-ish area, give or take a little bit. And I think that's going to be elevated enough that it's going to make it very hard for the Fed to stimulate in the next recession. And that's again, really a tricky scenario, because I feel like the markets are so conditioned to say, oh, well, if we go into a recession, no big deal. The Fed will print some money and we'll get out of it in 6 months or whatever it may be. But they can't do that, because what'll happen is you'll see inflation surge back, this time maybe higher than 10%, maybe 15%. And again, that's going to keep them on the sidelines. And the markets, like a child that kind of doesn't have their parents standing by to protect them anymore, the market is going to have to figure it out on its own, and it probably won't be super fun.
Yeah, it definitely doesn't sound like we're going to be having a fun time. So, we've been talking about the Fed. We do have the next meeting coming up later this month. What do you see coming there? You mentioned the possibility of 75 basis points. We did have Powell with very hawkish comments earlier this week. So, what's your view on that?
Yeah, so I found that so fascinating, right? And so let's rewind even more to Jackson Hole. So Jackson Hole, he came out extremely hawkish, like the most hawkish I think we'd ever heard him speak. And the markets freaked out, and we saw a big sell-off that day, and really the following 1 week period was a massive sell-off in the stock market. But if you look at the underlying factors, the market, the bond market, which is actually the smarter of markets, it's the market that has more money, it has more big money. So people think about it as being the smarter of the markets when you compare the stock market to the bond market. The bond market did not believe him, right? So let me bring up this chart, and I think this is such a cool chart to show. So we're going to look at the 10-year yield chart. So the 10-year yield, which is interest rates. And if you look at, this is the daily chart, and over here, this was in June. So in June, the 10-year yield was at 3.5%. When the comments for Jackson Hole came out, we were at 3.1, and we've only gone back to 3.3, even with the most hawkish comments the Fed has ever put out on hiking rates and being just hard against inflation. And what that tells me is that they believed that rates were going to go higher back here than over here. And so basically the bond market is calling the bluff from Jerome Powell and saying, you know what, we think you're talking a tough game, but we think that when the economy starts to weaken, you're going to back off really quickly, and we're not going to see rates as high as what the stock market is thinking in this situation. And I think you could almost confirm that with the DXY, right? So yesterday, or in the last couple of days, we had those comments from Jerome Powell again. He reiterated his hawkishness. And what happens to the dollar? Instead of rallying higher, it actually fell. And so again, now the currency markets are starting to doubt Jerome Powell. So I'm in the camp that I think it all depends on the CPI data next week, whether it's 50 or 75. But I do think if the inflation comes down decently, we might only see 50 basis points in the September meeting.
So it's looking like a toss up, at least for now.
Yeah.
So we'll be watching closely
Until that
CPI.
CPI, exactly.
Right. And you know what I realized when I was getting ready for this interview is we haven't spoken since we got the GDP numbers that showed us we'd had 2 negative quarters of growth, which typically we would see as a recession. It seems like we aren't ready to call that yet. So what are your views there? When do we actually get to saying, okay, we're in a recession?
Yeah, and I think the main reason for that, and a lot of people are confused, is that coming off of the pandemic, there's some really weird dynamics going on. So it's a little bit different versus the GDP of a normal cycle versus what we did see. So I understand why people are kind of like not willing to call that a recession. Now, having said that, I do think that if you see another quarter of negative GDP, then absolutely you have to call that a recession. And I also think if you start to see the jobs numbers decline into negative territory where we're actually losing jobs numbers, then you also have to say, okay, at this point, we think that we're in a recession at this point. But very weird time right now coming off of COVID.
For sure. And I think another thing for people to keep in mind heading into September is the Fed is also looking to ramp up its balance sheet reduction. So I wondered if you could talk a little bit about that and what we should pay attention to there.
Yeah, so that's almost one of the reasons as well why I'm kind of leaning towards, if I had to choose, was there it's a 75 or a 50, I'm going with 50 right now, not only because I think the CPI number is going to come down a little bit and make it more comfortable for the Fed to do 50, but also because they're reducing their balance sheet, which when they reduce their balance sheet, it also works as a tightening measure. So it's almost like they would almost equal 75 basis points by doing 50 basis points and also reducing their balance sheet at the same time. And I think the Fed has to be so careful. Like this is, and again, he has to talk a hawkish game. I understand Jerome Powell, but they have to be so careful that they don't overdo it and push us into a bad recession, because it's not like 5 years ago or 2 years ago or 6 years ago where they can print us out. They can't. And so if they really trigger a bad recession, the economy is going to be stuck in that recession until it figures its own way out. And that, I hope the Federal Reserve is very aware of that.
I'm sure we'll see. So as we're talking about recession, I want to bring you back to oil. You started talking about oil. It's something we've spoken about before. I know with these recession conversations happening, not just at the country level, also globally, people are getting worried about oil demand. You're speaking about the prices, and you've warned us before, keep an eye on when you need to get out. So what are you seeing in the charts in terms of oil at the moment?
Yeah. So again, when oil was trading, I think even in our last discussion, I said I was generally bearish on oil, even though everyone was saying, oh, it's $115, $120 a barrel. It's going to go to 150 to 200. And the key is this, is that everyone's thought process for why it was going to spike was that Russia's oil wasn't going to be bought and put on the market. So you had this reduction in oil, big reduction in oil that was on the open market. And the reality of it is I clearly knew from past experiences with Iran that they just sell their oil at a discount to China, to India, to other countries, and other countries are more than willing to take that oil. So you weren't really removing oil off of the open market. In addition, the Federal Reserve tightening, the ECB is tightening, everyone's tightening interest rates. What does that do to the economy? It slows the economy down. So if you have a global slowdown, OPEC just a few days ago was like, oh, we're going to cut 100,000 barrels of production. That means nothing when you have a global slowdown, because you're taking millions of barrels of demand off the table. So I think that's the key, is to look at the economy, the economics of the situation, understand how oil's still going to get out there just at a discount anyways. And it just leads you to believe that I still think oil is going to go lower. You could be due for a bounce. In fact, if we look at the chart here, I always like to show my charts. You could see we actually did recently just hit this trend line, which again, you're seeing a bounce today. We're back to about $86.77. But I think this is just a bounce before we break this line. And I think you're headed into the mid 70s by year end. So I still think there's more downside. And again, it's going to coincide with seeing the economy in the US continue to signal recession potentially. And I think Europe's going that direction, maybe even worse than the US because of the natural gas crisis. And I think most of the world, I think China's already kind of there already due to what I'm hearing as well.
Right. So, okay, thank you for showing the chart there on oil. I think there is, despite the price going lower, there's interest in oil. And I think that ties into what's going on in the energy markets, right? People hear about the energy crisis in Europe. They wonder, will that spread elsewhere? So do you see a way to play energy right now, or are we at that part where it's, too hyped up? There's too much attention.
Yeah, so I mean, it's finally coming down into that, like that trend line we looked at. That would have been a quick trading opportunity where you go long for a week or two. But I think you have to just look at the economics of the situation and just be really, really careful. With the economy potentially headed towards recession, that's just a reason to be very careful about buying oil here. Again, shorter term trades I think are okay, but be very, very careful. And the other thing I'd point out on natural gas, right? Natural gas was basically guiding investors to expect downside. And I love pointing this out because it's kind of a different view to the retail investor, right? The retail investor is very focused on what is the news media saying, is the hype there, what's going on, Russia. And what we heard was a week ago from today, last Friday, we saw that Russia shut down Nord Stream 1 100%. And there was a 3-day weekend here in the US, Labor Day on Monday, and everyone was like, oh my goodness, natural gas is going to go nuts. And on that Friday, when they announced the shutdown, the stock market fell sharply, but natural gas did not spike. And when you see these disparities in price where fear of a spike is occurring, but underlying price is not spiking, you have to take that as, wait a minute, price is truth, not emotion, and it's going to sell off. And what happened then this week? Natural gas collapsed. So those little things to look for are very, very helpful for investors and traders.
Right. And keeping on that energy theme, I have to ask you about a favorite among our audience, which is uranium. We touch on it sometimes. I don't know if you follow it very, very closely, but I wondered, there's so much positive sentiment around supply demand fundamentals. But when you look at it from a technical perspective, do you also see that?
Yeah, so uranium's had an amazing move over the last 2 weeks. We're starting to hear about maybe some nuclear power options coming back. If we look at the chart, number one, I mean, this is just a beautiful thing, right? So you had this trend line here, and every time price hit it, come here, 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 it was a buying opportunity. So here what we saw is this downsloping trend line, you broke out. So you've had a short-term breakout on uranium, and this is the URNM, so it's the uranium ETF. But basically what you want to be careful of if you're a uranium investor is you are coming up to another resistance point on the URNM at around 86.50. So just be aware that if you get around 86, price is going to run into a roadblock and it may have trouble. That might be your level to see a bigger pullback. Now, how big of a pullback, I'm not sure. I think overall, this is a bullish consolidation macro pattern, which means the longer term is still bullish on uranium. But as a shorter term investor, you want to be very careful if price gets to 86, 86.50 and look for a pullback. As an investor, for me, I wouldn't be a buyer here because it's already rallied too much with very little reward left. So I would look for it to hit that level, pull back and consolidate, and I'd be looking to buy that pullback.
Okay, very helpful. Thanks for going over that as well. So we need to make sure that we look at gold. And I mentioned it's been, kind of a slow summer in the resource sector. I know that a lot of our audience is getting a little bit tired of hearing that gold has maintained its value. It's going to go up. You've told us, I think the last time we spoke, the latest kind of outlook for gold was 2,400, 2,500 within the next 12 months. So I want to check in with you on that, maybe hear from you on why we should still be believing in gold.
Yeah, so very, very true. And the number one thing is I think by year end, my price target as of the beginning of the year was about 2,400. That's not going to happen this year. I think you might get back to 2,000 and a half, which would be that high, that triple top high. But the dollar strength has just taken a lot of energy out of the sales of gold, right? So when the dollar goes up, gold generally reacts and goes to the downside. The only thing I would point out, and this is a really cool point about gold has still been an amazing performer this year. Number one, if you looked at gold in terms of euros, it's having a great year. If you looked at it in terms of yen, it's having an awesome year. In terms of the dollar, not so great. But even then, the dollar's rallied 15% this year, and gold is only down about 4 or 5% for the year. So think about that. In a normal market, if someone told me the dollar was going to be up 15%, I would be like, okay, well, gold should be down 15% then. The fact that it's only down 4 to 5% tells you that it's actually doing its job and holding on to its value very, very well, especially when you compare it to the S&P or Bitcoin or anything else. So I think, again, you have to just say gold is doing its thing. If the dollar, and eventually the dollar will pull back dramatically, then gold will have its big epic move here. What I love seeing is this sideways chop on the daily chart. This again is bullish consolidation, and eventually the probabilities dictate that this pattern eventually breaks to the upside. So again, it's not the sexy mover. We're not seeing those big moves in it, but in reality, it's actually been a very, very solid performer in spite of a really strong dollar.
Right. And so good job for gold. If you were somebody, though, who was invested in the gold companies, for example, if we look at GDX or GDXJ, it's not looking so good. So can we talk about that discrepancy? And do you see that as an opportunity on the stocks side?
Right. So, and this is a great point, is because a lot of people are love the miners because you get a bigger bang for your buck. Usually, if gold goes up a little bit, the miners go up a lot more. The reason that hasn't happened and the miners have declined so much is because of inflation, right? So if gold is staying steady and the miners are mining, what's ending up happening to the miners is they still have to purchase equipment, pay people to mine that gold. And we know that wages have gone up dramatically. The price of materials have gone up. So all of their costs from mining have gone up sizably, but the price of gold hasn't gone up. So that's where the disparity comes in, where their earnings are getting hit because of that. So the miners have been under a ton of pressure, but this is the cool part about it. The mining chart, the GDX chart, hit a major support this week at these lows. And I love, the biggest thing for me is these parallel channels where you connect the highs and then you look at where the lows are and look at this area to this area and look at the low this week. And then look at this secondary level right here and how that coincides. And if we zoom in, that's right the low on the GDX. So GDX has already bounced off of it. I would say look for maybe consolidation, and then GDX is a big buy here. My thesis for why I think GDX is going to be good for the next 3 to 6 months is that as you see inflation coming down, I do think the miners start to outperform now. So they were underperforming as inflation was going up and getting scarier and scarier. They should outperform now if inflation does come back in.
Okay, that makes a lot of sense because, all you have to do is talk to these companies, read their financial statements, and you'll see that impact of
Yeah.
inflation. So,
And in fact, one
yeah.
more point, and it's super intriguing point, is like, so Newmont Mining reported earnings, and one of the things they said is they said, we're going to stop mining in this particular way because it's too costly. And I thought that was fascinating because it reminds me of how Bitcoin does its halvings, where it gets harder or more expensive to mine and it reduces supply. And the idea is as prices go up for mining and mining equipment and labor, these companies are going to mine less because it's too costly. And what that does is it reduces the supply of gold coming onto the open market, which inevitably, if you reduce supply and demand is there, price will inevitably go up. So it's another signal why, and again, this is a more of a longer term signal, but it's another signal why demand will go up and price ultimately should go up on gold.
Okay, and I think we have a good segue there then over to Bitcoin. So last time we spoke, it had just gone below 20,000, which was a level that you had been calling for quite some time. So we had discussed that. I think we were looking for what was it going to do next? And you said it could go down to 12,000, 13,000. I think this summer we've kind of seen it do more of a sideways thing. So what's going on with Bitcoin?
Yeah, so Bitcoin's been dancing right around that 20,000 level. And the reason why I was harping on 20,000 is because that happened to be the high from the last bull cycle. So in 2017, we saw this unbelievable percentage move to 20,000, and then the bear market started. Finally, we got into the next bull market. And then basically when price came down there, you would expect it to have some bounce and some sideways chop. And that's exactly what we've seen here. It doesn't change my view that Bitcoin is not at a bottom yet. Bitcoin in its normal bear market cycles goes down about 80 to 85%. I think it's only down about 70%. And this is the first bear cycle the Federal Reserve has not been printing money during it, right? So in every past bear market cycle, the Fed's been printing money with QE and QE1, QE2, and all those. And this is this first cycle it isn't printing money. And that makes me wonder if at least we go down 80 to 85%, which gives me that 12 to 13,000 target, or could we actually go even a little bit lower? So I think that we're still going to see another leg down, minimum 12 to 13,000, and then I'll have to reevaluate if it's going to go lower after that.
Okay, we'll be looking for that. Now, on the note of Bitcoin, we're going a little bit further from my areas of expertise here, but more toward yours, I think. So that's good. I wanted to check in with you on the Ethereum merge. What does that mean for Bitcoin? From what I'm understanding, it's going to really reduce the amount of energy that the system needs, which sounds to me good, but I'm guessing that there is more to it than that. So what are your thoughts?
Yeah, so I think that is a very important aspect about reducing energy, because I know that a lot of fund managers and investment portfolio managers, one of the things that they're always pressured on is being very environmentally conscious, right? So that's going to alleviate that issue. And then also the merge is going to change the way the mining is done, which almost creates it as a deflationary asset, almost like kind of a Bitcoin. So I actually think longer term, this is really bullish for Ethereum. And I do think that it makes it much more attractive to investors overall, not just for the utility purposes, but also for the savings and kind of a different way to invest versus holding US dollars and other currencies, fiat currencies. So I think that's very good. I think the biggest thing next week with the merge is it has to go smoothly, right? So, and this is big for the entire crypto market. Everyone's looking to that. They need to nail it to give the confidence to the crypto markets. If they do, I think you could get a little short-term upside, kind of the relief of, okay, it happened, it went smoothly. It doesn't change the fact that I think eventually Bitcoin's going to 12, 13,000, but in the near term, it should be a positive.
Okay, well, thanks for going over that. As we are wrapping up, I want to take a quick look at the overall market. So a couple of things you said before. You said previously you wouldn't be surprised to see the S&P 500, the NASDAQ composite. You wouldn't be surprised if they put in their highs for many years to come. And I know you've said in recent interviews on other channels, you see the stock market maybe reaching new lows in 2022. So let's talk about that big picture just as we're finishing up.
Yeah. So, I mean, I think at this point, the rally we had from even 2009 when the Fed began printing money was so vertical that it pulled forward a lot of the upside in the market, very much like you saw happen in China about 10, 12 years ago, Brazil 10, 12 years ago. And what's interesting about those markets is they've been chopping sideways for 10 years, actually more than 10 years. And so it's very similar. Like you look at you, in fact, let me show this chart. I want to show you this because it's super powerful to kind of envision here. So if we go to the monthly chart on the S&P, this was the 90 run, the pullback, the 2000 up to 2007, the pullback. And then this is where the Fed started printing money. And look at that. That is not a natural market move. Now, what's interesting here is if we go to something like the EWZ, which is the Brazil ETF, look at this move on the Brazil ETF. And then again, go back to, put that trend line in, let me erase that. And then go back to the SPX again, and look at that same move. It's almost identical, right? The vertical nature. And if you look at the EWZ, which is the Brazil market, the ETF for the Brazil, what did it do after that? It topped out after this ridiculous run, big correction, upside, downside, upside. And basically it's been chopping sideways now since the high in 2008. And so you're now talking 14 years that the Brazil market has not outperformed. And if you look at the Hang Seng market, it's very similar, right? Let me bring up that correct chart here. Bear with me, Hang Seng, there we go. So again, if we look at that chart, you had this monster run from 2003 to 2007. And then look at the chart, how again, it's basically trading currently at levels that it was trading back in 2006. And so you're talking about 14, 16 years of sideways action in the Hang Seng China stock market without a real breakout to the upside. So I look at this move and all I see is the S&P over the last, 11 years, right? Since 2000, since 2009. So back last 12 years, 13 years. So that's my concern, is that we're now entering this phase of the cycle. And again, markets work on cycles, folks. You have to understand that. And so I am concerned we're going to see this, then we're going to see a lot of this for like 10 years before we finally break out. Now, having said that, the question is, well, where do you invest? Well, the two charts I just showed you, to me, you don't want to obviously overinvest, but if I had to choose right now, US market be long or China / Brazil and some of those countries, the South American countries, I would absolutely be going towards those for the next bull move.
Okay, I think that is a good place to wrap it up. We've got some short-term ideas. We've got the longer term. Thank you so much for coming on to go over everything that's happening in the markets. It's great to have you as always.
Oh, Charlotte, it's awesome to talk to you. Thank you so much.
Of course. So once again, I'm Charlotte McLeod with the Investing News Network, and this is Gareth Soloway with InTheMoneyStocks.com.